see you. Thank you for joining us. I look forward to talking about X Out, right, your ETF, and give us some details on that. But first, give us what you're thinking about the market here. You know, our previous guest was using the word bubble, and people are nervous, and we have volatility. But there are people who are eyeing new highs by the end of the year. So where do you stand?
Great to be with you, Nicole. Great to see you, and thanks for having me on as usual. So in terms of the market, I think from our business, we are in the kind of fortunate position, really, to say that, you know, for us, business is growing and we're positioned well from an investment fund perspective. You know, probably it wouldn't surprise you to know that one of the major interests from our perspective has been gold. And so we've had a lot of people buying BAR, which is our gold ETF. Interestingly enough, on the broad commodity side, we've also seen people come into the broad commodity market again and looking to buy, given the recent price action we've seen in oil. But in terms of the broad market, I think you're absolutely right. Since the intervention of the Federal Reserve, the market has gone on a pretty significant tear here over the last few weeks. And I think the Jerome Powell 60 Minutes interview that everybody saw over the weekend confirmed that the Fed is definitely not out of bullets and will continue to support this market. So it seems like almost, you know, the bulls and the bears are satisfied. If you're in the bearish camp on the gold side, you're thinking that all this money printing is going to lead to inflation and therefore you want to be in gold. And then if you're on the bull side, you think all of this support and intervention is good for stock market and therefore we keep buying stocks. So I think the stock market will continue from here for some bit.
Yeah, I understand what you're saying. Just to clarify, and we're showing BAR here, is that still something to get into? I guess you were talking about some of your clients getting into that as a nice safety play. Is that something that you would recommend, BAR or gold stocks? Is that just before I get to some of the stock picks?
Yeah, definitely. I mean, I always say to people that gold should be a part of the portfolio regardless of the market cycle. But I think right now, you know, one of the things, it's less about a safe haven per se at the moment, but more fears of inflation due to all the money printing. And, you know, this is exactly what happened, obviously, after 2008. If you bought gold in 2008, didn't matter when you bought gold, whether it was at the high that year or at the low, but you made money in the years afterwards as obviously the impact of that hit and gold prices soared to an all-time high. So I think people are looking for that again, and therefore people are looking to buy gold.
Yeah. Tell me about some of the names that you like. I mean, some of your better stock picks included Adobe. That was in there. Also, Eli Lilly. I know you have a lot of big cap names that you have in the X Out fund. Tell me why these are some of your best bets.
So I think with X Out, you know, remember the important thing is we believe that it's more important what you don't own versus what you do. And the reason for that is because we're trying to exclude companies here that we think are vulnerable to technological disruption. And so when you look through that lens, you're obviously going to get portfolio companies like you mentioned, Adobe, Eli Lilly, the Amazons, the Googles, the Microsofts, that are thriving in this particular environment. But what this has done, the COVID-19 I'm talking about particularly, is created this chasm in the stock market where you're going to have the haves and the have-nots. And that's what X Out is all about. We want to exclude the have-nots because they're really the things that detract from your performance. That we all know that over the long run, it's actually only a handful of stocks that contribute to the broad market performance. And for the most part, people own that. And then at the edges, you know, I heard your previous guest talking about Target. You know, there are companies out there that are doing really well in this environment that have a good digital game on, that are being able to take advantage of this environment to create more sales, to generate more activity online. But I think for us, we want to focus on those companies that you don't want to own. And so starting with Walmart, which is our biggest one in the X Out strategy, this is completely unemotional, it's completely rules-based, and we want to screen out those stocks that are not going to add to performance. And over the last quarter, our top 10 danger stocks, as we called it, they underperformed the market by almost 8%.
Yeah. Danger. I mean, that is a big word, and this is why you've X'd them out of your fund. You have Walmart in there, which a lot of people seem to like. They think it's a staple, and people are going there. They're shopping, and they have a great e-commerce. I really need to hear more why Walmart is X'd out. Also, JP Morgan and Exxon are your danger stocks, too. Tell me a little bit about Walmart in particular, and then maybe add on for the others.
Yeah, this is a great one, and is one that causes quite a lot of controversy because it's a stock that nearly everybody owns, especially if you're in the broad market. So a lot of people say, "Oh, why are you excluding Walmart? How can you exclude them? They bought Jet.com, they did Flipkart, they have a good digital distribution game going on." Well, remember, this is completely unemotional. This is about a screening process that is quantitative, that identifies the companies to leave out. As we all saw actually today, Walmart actually announced that they're exiting the Jet.com acquisition. But leaving that aside, the fundamental issue with Walmart is it's just too big. And so growing on a relative basis is incredibly difficult because of the size of the company. So in terms of growing its sales, if you factor in inflation, it's actually going backwards rather than forwards. And that's just a function of how big it is. It still very much relies on its physical distribution, as opposed to a natural competitor like Amazon, which is obviously much more virtual or digital. So Walmart certainly is one that has trouble growing, even though it's fundamentally a good business. We've got other companies like JP Morgan. This is probably a more obvious one, but we did flag this before COVID-19 as one of our top X outs. When at the time it was struggling to grow deposit growth and the buybacks were financed poorly. But obviously now with soon to be potentially negative interest rates, but certainly zero interest rates, it's creating a very troubling environment for banks. So it's difficult for banks to make money when you have interest rates at zero, not good for banks
Right.
and other parts of the economy as well.